It's decision day for the Fed in its battle to fight inflation. For the first time since the start of the pandemic, the Federal Reserve says it'll soon be ready to raise its benchmark interest rate, which has been sitting at near zero for nearly 2 years. Notably, it'll also be the first rate increase since 2018. Since the Fed doesn't meet in February, indicators point to it happening as soon as March.
I think there's quite a bit of room to raise interest rates without threatening the labor market.
The decision comes as the country deals with the hottest inflation in 40 years, fueled in part by supply chain struggles.
There are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
After dramatic measures to stabilize the economy during the pandemic, the Fed says it's about time to dial it all back with inflation so high and unemployment at 3.9%. That includes ending asset purchases in early March, according to the Fed. But in a step beyond tapering, the committee announced it could soon start shrinking its balance sheet sometime after raising interest rates, saying when that happens, it'll be in a predictable manner. Well, the markets were not predictable. They bounced around, mostly down the entire time Chair Jerome Powell spoke. Powell, for his part, is still waiting for the Senate to confirm him for another 4 years as Fed chair. He testified earlier this month, and his current term is up the first week of February. I'm Simone Del Rosario, and from New York, it's Just Business.